Welcome to a new video where we delve into the fascinating world of investment. Today's topic is the 2 ETF dividend portfolio pays you every month. Now, you might be wondering, what exactly is an ETF? Well, ETF stands for Exchange Traded Fund. It's a type of investment fund and exchange-traded product traded on stock exchanges much like individual stocks. ETFs hold assets such as stocks, commodities, or bonds and generally aim to track the performance of specific indices. Now let's talk about dividends. Dividends are a portion of a company's earnings that are paid out to shareholders, and they're a significant attraction for many investors. They provide a steady stream of income in addition to any market price appreciation. When you combine the concepts of ETFs and dividends, you get a dividend ETF, which is an ETF that focuses on dividend-paying stocks, but we're not stopping there. Today, we're focusing on a 2 ETF dividend portfolio. Now, why 2, you might ask? Well, the beauty of having 2 ETFs in your dividend portfolio is that it allows for diversification, which can help to mitigate risk. By spreading your investments across different ETFs, you're not putting all your eggs in one basket. In our context, we will be focusing on 2 specific ETFs, SCHD and JEPQ. SCHD, or the Schwab U.S. Dividend Equity ETF, seeks to track the performance of high dividend-yielding U.S. stocks. On the other hand, JEPQ, or the J.P. Morgan Equity Premium Income ETF, aims to provide investors with regular income through the use of an option strategy, while also providing exposure to large-cap U.S. stocks. Both of these ETFs have their unique characteristics and benefits, which we will delve into in the upcoming scenes. As we unravel the concept of a 2 ETF dividend portfolio, we invite you to join us on this informative journey. Let's together explore how this strategy can help you generate a monthly income and potentially strengthen your financial future. Hello viewers, if you are enjoying this content and you do not want to miss future videos filled with even more tips, tricks, and inspiration, hit that subscribe button now to stay tuned with us, and remember to comment and share. Before we dive deeper, it's crucial to understand what dividends are and why they matter in your investment journey. Imagine you're at a party. The host is a successful company, and as a shareholder, you're a guest. Now the company has made a hefty profit, and it decides to share a slice of the cake with its guests. This slice of the cake is what we call a dividend. It's a portion of a company's earnings that gets distributed to its shareholders. Dividends can take the form of cash payments, additional shares of stock, or other types of property, but for the sake of simplicity, let's stick to cash dividends for now, the most common form. So, why are dividends important? Well, they represent an income stream that's separate from any profits that might come from selling your shares. In fact, many investors, especially those planning for retirement, rely heavily on dividends for their regular income. It's like having a job that pays you not for your labor, but for your trust in a company's ability to make money. Dividends also offer an insight into a company's financial health. Regular and increasing dividends could signal a company's strong financial position. On the other hand, a cut in dividends might raise a red flag about a company's profitability. But here's a pro tip. Consider the dividend yield. It's the annual dividend payment divided by the market price of the stock. It gives you a better picture of how much bang you're getting for your buck. At this point, you might wonder, sounds great, but how do I earn dividends? Simple. Buy shares in a dividend-paying company, hold on to them, then voila, you're on the guest list to the profit party. However, it's not always a smooth ride. Dividends can fluctuate depending on the company's profits and board decisions, so always remember to do your homework before investing. Now that we understand dividends, let's explore how they fit into a 2 ETF dividend portfolio. A 2 ETF dividend portfolio can be a game changer for investors looking for consistent monthly income. Let's find out how. Imagine having a financial engine that consistently churns out monthly income. That's the beauty of a 2 ETF dividend portfolio. It's an investment strategy that involves 2 exchange-traded funds, or ETFs for short, that generate dividends. So, what are ETFs? These are essentially baskets of stocks, bonds, or other assets. By investing in an ETF, you're buying a piece of that entire basket, not just one company's stock. This allows for diversification, which can help mitigate risk. Now, let's take a closer look at the 2 ETFs often used in this portfolio strategy, SCHD and JEPQ. The first one is SCHD, short for Schwab U.S. Dividend Equity ETF. This ETF is designed to track high dividend-yielding U.S. stocks. It focuses on companies that have a record of consistently paying dividends, hence providing a regular income stream for investors. SCHD's yield, which is the income return on an investment, is quite attractive. It has consistently delivered a yield of around 3%. This means that for every $100 you invest, you get about $3 back each year in dividends. Not a bad deal, right? Now let's shift gears to the second ETF, JEPQ, the Global X Super Dividend Alternatives ETF. This ETF aims to provide a high level of income by investing in a range of asset classes around the world that have high dividend yields. The yield of JEPQ is even more impressive. It usually hovers around 7%. So if you invest $100, you could expect to receive around $7 back each year in dividends. The magic of the two ETF dividend portfolio lies in the combination of these two ETFs. By investing in both, you're diversifying your portfolio across different asset classes and geographies. This not only spreads the risk, but also optimizes the potential for returns. Moreover, SCHD and JEPQ typically pay their dividends at different times. This means that by holding both in your portfolio, you can receive dividend income on a monthly basis. One month it might be SCHD paying you a dividend, the next it could be JEPQ. So, there you have it. By understanding the mechanics behind a two ETF dividend portfolio, you can capitalize on the benefits of diversification, high dividend yields, and consistent monthly income. It's a strategy that's not just savvy, but also remarkably simple. With the right combination of ETFs, a two ETF dividend portfolio can indeed pay you every month. The idea of receiving a monthly income from your investment sounds appealing, doesn't it? Let's uncover the benefits of a two ETF dividend portfolio. First off, let's talk about diversification. A two ETF dividend portfolio enables you to spread your investments across a wide array of sectors and companies. This is like casting a wide net in the ocean of investing. It helps ensure that you're not overly reliant on the performance of a single company or sector. Diversification is a savvy way to mitigate risk, and this portfolio gives you that in spades. Secondly, this type of portfolio is typically lower risk. By investing in two ETFs, you're not putting all your eggs in one basket. If one ETF underperforms, the other might pick up the slack. This reduces the overall volatility of your portfolio, providing a smoother and less stressful investing experience. Remember, investing is a marathon, not a sprint. Lower risk can lead to consistent, long-term growth. Thirdly, a two ETF dividend portfolio can provide a steady income stream. ETFs that focus on dividends are often composed of established, profitable companies that regularly pay dividends to their shareholders. By holding two of these ETFs, you're setting yourself up to receive these dividends, essentially getting paid while you sleep. This can be a fantastic supplement to your regular income or a way to build wealth over time. Lastly, let's not forget the power of compounding. Reinvesting your dividends can lead to exponential growth over the long term. It's like a snowball rolling down a hill, getting bigger and bigger with time. This is one of the most powerful ways to grow your wealth. Clearly, a two ETF dividend portfolio offers many benefits, but it's not without its challenges. It's essential to remember that all investments carry some degree of risk, but with careful planning and a solid understanding of your financial goals, a two ETF dividend portfolio can be a valuable tool in your investing toolkit. Like any investment strategy, a two ETF dividend portfolio comes with its fair share of challenges and risks. It's important to be aware of these. A two ETF dividend portfolio, despite its numerous benefits, is not immune to market uncertainties. The first challenge to consider is market volatility. The value of exchange-traded funds, or ETFs, fluctuates with the market. Therefore, if the market experiences a downturn, your portfolio might suffer a decrease in value. This is a risk inherent in any market-linked investment strategy. Another potential challenge is the risk of dividends being cut. While ETFs are designed to provide consistent dividends, these payouts are not guaranteed. They depend on the companies within the ETF being profitable and deciding to distribute their profits as dividends. If these companies face financial difficulties, they might choose to cut or eliminate their dividends. This would directly impact your dividend income. Then there's the risk of over-concentration. A two ETF dividend portfolio, by its nature, is more concentrated than a portfolio made up of several different investments. This means that if one of your ETFs performs poorly, it can have a significant impact on your overall portfolio. In addition, some ETFs have high expense ratios. These are the fees charged by the fund manager for managing the ETF. High expense ratios can eat into your returns, especially over the long term. Therefore, it's crucial to pay attention to the expense ratios of the ETFs you choose for your portfolio. Lastly, there's the risk of not being diversified enough. While a 2 ETF dividend portfolio does offer some level of diversification, it might not be enough depending on your financial goals and risk tolerance. For instance, if both your ETFs are focused on the same sector or region, you could be exposing yourself to unnecessary risk. Despite these challenges and risks, it's important to remember that they can be managed with careful planning and strategy. For example, you can mitigate the risk of overconcentration by choosing ETFs that are diversified across different sectors and regions. To address the risk of high expense ratios, you can carefully compare different ETFs and choose those with lower fees. And to handle market volatility, it's vital to have a long-term investment perspective and not make rash decisions based on short-term market fluctuations. In conclusion, while a 2 ETF dividend portfolio does come with its share of challenges and risks, these should not deter you from considering this investment strategy. Instead, being aware of these risks and challenges can help you make more informed decisions, manage your expectations, and make strategic adjustments to your portfolio when necessary. Knowing the risks and challenges helps you make informed investment decisions. So is a 2 ETF dividend portfolio right for you? Every investor is unique, and so are their financial goals. Let's see if a 2 ETF dividend portfolio aligns with your investment objectives. When it comes to investing, there's no one-size-fits-all solution. The right strategy for you depends on a variety of factors, including your risk tolerance, financial goals, and investment timeline. A 2 ETF dividend portfolio can be a powerful tool for generating consistent income. It's a strategy that involves investing in 2 different dividend-paying exchange-traded funds, or ETFs, to create a diversified income stream. But is it right for you? Let's take a closer look. First, consider your financial goals. Are you looking for a steady income stream to supplement your earnings or fund your retirement? A 2 ETF dividend portfolio could be an excellent fit. This strategy is designed to provide consistent monthly payouts that can serve as a reliable source of income. But what if you're more focused on growth? A 2 ETF dividend portfolio can still be beneficial. While the primary focus of this strategy is income, the ETFs in your portfolio also have the potential for capital appreciation. This means that in addition to dividends, your investment could also grow in value over time. Next, think about your risk tolerance. No investment is without risk, and a 2 ETF dividend portfolio is no exception. However, the risk associated with this strategy is often lower than that of investing in individual stocks. This is because ETFs are inherently diversified, spreading risk across a variety of different companies rather than concentrating it in a single stock. But remember, lower risk doesn't mean no risk. It's crucial to understand and be comfortable with the potential risks before diving in. Lastly, consider your investment timeline. A 2 ETF dividend portfolio can provide immediate income, making it an attractive option for those nearing retirement or in need of a consistent income stream. However, this strategy also requires patience. Dividend investing is a long-term game, and the real benefits often come from compounding dividends over time. It's also worth noting that implementing a 2 ETF dividend portfolio doesn't have to be an all-or-nothing approach. You can incorporate this strategy into a broader investment portfolio, using it as one component of a diversified investment plan. In the end, the decision to invest in a 2 ETF dividend portfolio comes down to your unique circumstances. It's about understanding your financial goals, risk tolerance, and investment timeline, and making an informed decision that aligns with those factors. Only you can decide if a 2 ETF dividend portfolio is right for you. However, armed with this knowledge, you can make that decision confidently. We've covered a lot of ground today, exploring the world of 2 ETF dividend portfolios. As we wrap things up, let's revisit the key takeaways from our discussion. Remember, dividends are the portion of a company's earnings that are distributed to shareholders. They are a compelling source of income, especially for those looking to generate regular, passive income. The beauty of a 2 ETF dividend portfolio lies in its simplicity and its power to deliver dividends every month. We delved into the mechanics of this portfolio strategy, focusing on 2 ETFs in particular, SCHD and JEPQ. SCHD, the Schwab U.S. Dividend Equity ETF, is known for its focus on high dividend-yielding U.S. stocks. JEPQ, the Jefferies Equity Premium Income ETF, complements this with its option writing strategy that generates income. The The combination of these two offers a unique blend of stability and income generation. But as with any investment strategy, there are benefits and challenges. The benefits include diversification, regular income, and the potential for capital appreciation. The challenges, on the other hand, encompass market volatility, potential lower returns compared to growth stocks, and the need for careful selection and regular monitoring of your ETFs. Determining if a 2 ETF dividend portfolio is right for you depends on your individual financial goals, risk tolerance, and investment horizon. It may be a fit for those seeking regular income, particularly retirees, or those who prefer a more conservative, less volatile investment strategy. The world of investing is vast and complex, but with the right knowledge and tools, you can navigate it with confidence. 2 ETF dividend portfolios are just one of the many strategies you can employ to build your wealth and secure your financial future. Thank you for joining us on this journey. If you found this video helpful, please subscribe, like, and share it with others who might find it useful. Until next time, happy investing.